Hello and welcome to Investment Insight. Before we begin, make sure to subscribe and hit the like button. Now let's break down what's happening in the markets today in a clear and simple way.
Yeah, there is definitely a lot to cover today.
Oh, absolutely. So if you're a beginner investor, you might just look at gold as this shiny safe haven asset, right?
Right, like something you just buy a little bit of when the stock market looks a bit shaky.
Exactly. But according to recent analysis, there is something massive happening right now behind the scenes.
There really is. It's a complete structural shift.
Yeah, the mission for our deep dive today is to really unpack this. Because right now, under the streets of Hong Kong, they're building an entirely new financial ecosystem.
And they are literally combining physical gold, offshore Chinese yuan, and government bonds into this, well, into a closed loop system.
Right, which sounds a bit dry at first, but looking at the data, this isn't just them launching a new gold exchange. It is a strategic move to capture global de-dollarization demand.
Exactly. They're building a parallel track to the US dollar.
And as an American investor, looking at my retirement accounts, I really want to understand how they are actually doing this from the ground up.
Well, it starts with the actual physical concrete, the vaults.
Right. Let's talk about the vaults because, to compete in global finance, you can't just set a price on a digital screen.
Oh, absolutely not. You need trust, you need rules, and you need a physical place to put the assets.
I always like to use Amazon as an analogy for this.
Oh, yeah, the fulfillment center comparison.
Right, because anyone with a credit card can hire a guy to build a website and sell things, right?
Yeah.
The digital storefront is the easiest part.
Exactly.
But Amazon totally dominates retail because they spent billions of dollars in decades building these massive physical fulfillment centers. They control the real-world delivery network.
And global finance is surprisingly similar. You have to build the financial fulfillment centers.
Right, and the data shows that is exactly what Hong Kong is doing. On July 7th, 2026, their new precious metals clearinghouse launched a trial run for a new central settlement system for gold.
And we should clarify, this isn't just paper certificate.
No, it's the real deal. They're using the international standard 400 troy ounce bars.
Which are incredibly heavy.
Yeah, for anyone trying to visualize it, a 400-ounce bar is about 27 pounds of solid gold.
Wow.
Yeah. So as a beginner investor, you might buy gold with a quick swipe on your phone, right? But moving one of these bars is a good way to throw out your back.
It's basically the classic heavy brick of gold you see stacked on pallets in like a bank heist movie.
Exactly. And the data indicates they're using the Bank of China in Hong Kong as the settlement agent for all this.
Right, and their goals are huge. Recent analysis shows Hong Kong plans to expand its total gold storage capacity tenfold.
Tenfold.
Yeah, tenfold. They are aiming for over 2,000 tons by 2030.
That is just a wild amount of gold.
It really is. And it's a direct move to compete with Singapore, actually. Singapore has been aggressively trying to be the ultra-safe wealth hub in Asia.
Okay, but here's my question. As an everyday investor, I look at finance today, and 99% of it is digital, right?
Sure, trillions moving at the speed of light.
Right. So why does Hong Kong care so much about pouring concrete and building physical vaults?
Well, because London's historical dominance in the gold market wasn't just about trading volume.
Okay, what was it about?
It was about trust. It was about massive, highly secure vaults, standardized bars, and legacy banking networks.
Oh, I see. Yeah.
Yeah, by establishing this institutional-grade physical storage, Hong Kong is deliberately lowering counterparty risk.
Counterparty risk. Let's break that down for the beginner investor.
Sure. So imagine you manage a massive global fund and you want to buy $50 million worth of physical gold.
Okay, sounds nice.
Right. But if you buy it directly from another bank over the counter, there is always this tiny, lingering risk.
Like, what if they go bankrupt before they hand over the gold?
Exactly. What if they fail to deliver or just don't pay up? When you are dealing in billions, a tiny risk is totally unacceptable.
Right, you can't just hope for the best with $1 billion.
No, you can't. So this new central system in Hong Kong acts as the ultimate referee. They are basically telling global central banks, you can safely park your physical gold right here in Asia.
So they built the world's safest, fanciest basement.
Pretty much, yeah.
But a vault is useless if no one is trading what's inside. Where is the actual demand coming from to fill these 2,000 tons of space?
Well, the demand is heavily coming from mainland China.
Okay.
Building the vault in Hong Kong is just step one. Step two is building a structural bridge connecting that international hub directly to the massive domestic demand in the mainland.
Wait, hold on. This is where I push back a bit, looking at it from an American perspective.
Sure, go ahead.
If China has all this internal demand for gold, which the data clearly says they do, why do they need Hong Kong at all?
That is a great question.
Right. Why go through the trouble? Why not just pour the concrete and build these massive vaults right there in Shanghai?
It comes down to legal frameworks and capital controls. Shanghai represents massive domestic demand, and everything there is priced in their local currency, the yuan.
Okay.
But global investors, like giant Western pension funds, they are absolutely terrified of China's capital controls.
It's the Hotel California problem.
Yes, exactly.
You can check your money in, but you can never leave.
That is precisely the fear. The mainland restricts how money flows in and out to control their economy.
So if a global fund puts $1 billion of physical gold directly into Shanghai, they're worried it might get trapped there by a sudden policy change.
Right. But Hong Kong operates under a completely different legal system. It uses international common law, and it has open borders for capital. Global investors already trust it.
So Hong Kong is basically the trusted Western-facing lobby for the Chinese financial hotel.
That's a perfect way to describe it. And recent data shows exactly how they are linking them. They just rolled out the initial phase of something called Delivery Connect.
Delivery Connect, what does that do?
It links Hong Kong directly with the Shanghai Gold Exchange. The Hong Kong Clearinghouse actually applied for international membership in Shanghai.
So they can easily move the physical gold back and forth across the border.
Exactly. Opening physical gold accounts to bridge the two markets seamlessly.
Oh, wow.
And on top of that, Hong Kong revived dollar-denominated gold futures and is looking heavily into yuan-denominated gold futures.
Okay, let's unpack that. Why is pricing gold in yuan so important?
Because it is vital for the internationalization of the yuan.
How does trading raw materials in yuan make it a global currency, though?
Well, think about the U.S. dollar. Global oil is priced in dollars.
Right, the petrodollar.
Exactly. So countries everywhere are forced to hold U.S. dollars just to buy the basic energy they need. China is trying to replicate a piece of that architecture.
By anchoring their currency to a hard asset.
Yes. By pricing universally valued raw materials like gold and yuan, they give global investors a tangible reason to hold the currency.
It's backed by real, hard assets sitting in a legally trusted vault.
Right. It transforms the yuan from just a local trade currency into a serious commodity-backed financial instrument.
Okay, so we have the physical gold acting as the shiny hook, and the vaults are creating the trust.
Correct.
But, gold makes the headlines because it's pretty easy to talk about. The real money in global finance is actually in the bond market.
Oh, absolutely. The bond market completely dwarfs the gold market.
Right, so for this whole Hong Kong ecosystem to actually work, these major institutions need a place to safely manage massive oceans of cash.
They need flawless financial plumbing.
Yeah, I look at it kind of like a casino.
How so?
Well, if gold is the flashy casino floor with the bright lights that brings you in the front door, the bond market and the liquidity facilities are the cashier's cage in the back.
Ah, I like that.
Right. High rollers simply won't sit down to play if they aren't absolutely sure they can cash in their chips instantly, or borrow more money the second they need it.
That is a great analogy. The plumbing behind the scenes has to be completely bulletproof, and the data shows Hong Kong is heavily reinforcing that exact plumbing right now.
Yeah, the numbers I saw in the research are just staggering.
They really are.
According to the data, the Hong Kong Monetary Authority and China's central bank just announced a ton of measures to strengthen their fixed income markets.
Right. For example, the Southbound Bond Connect program.
Yeah, they expanded that quota from 500 billion yuan to 800 billion yuan, which, just for our American listeners, is roughly $117.8 billion.
That is a massive margin of expansion, and that $117 billion isn't just a random number.
What is it then?
It represents the exact capacity needed to let giant Western pension funds actually participate without completely freezing the system.
Wow, okay. And they're building out the emergency credit lines, too.
Right, the RMB business facility.
Yeah, they expanded that liquidity tool from 200 billion to 500 billion yuan and extended the maturities up to 3 years.
Giving investors much more breathing room.
Exactly. And the most interesting part to me, the Hong Kong Exchange is launching 5-year China government bond futures on August 3rd, 2026.
That is a critical piece of the puzzle.
Let's break that down for the everyday investor listening. Why does a 5-year bond future matter?
It matters because a currency cannot become a true global reserve just by being anchored to gold.
Okay, what else does it need?
Well, if you are holding billions of dollars in Chinese assets, you must have tools to manage your risk. You have to be able to hedge against interest rate changes.
Hedging. Let's do a quick deep dive on that.
Sure.
Imagine I am managing a retirement fund for teachers in the U.S., and I decide to park $1 billion in Chinese government bonds because the interest rate is good.
Okay.
What is my absolute nightmare scenario, and how does this new futures contract actually save me?
Your nightmare scenario as a fund manager is that right after you buy those bonds, global interest rates suddenly spike up.
Because when interest rates go up, the value of the bonds I just bought goes down.
Exactly. A sudden shift could wipe out hundreds of millions of dollars from your teacher's retirement fund overnight.
I'd be fired instantly.
You'd be fired and the fund would be devastated. So a 5-year bond future acts as an insurance policy against that exact nightmare.
How does the insurance work exactly?
It's a contract that lets you lock in a price today, or profit if the broader bond market falls, which offsets the huge losses on the physical bonds you are holding.
Okay, so without those futures contracts acting as insurance, buying the underlying bonds is just way too reckless for a large institution.
Exactly. Without a deep futures market, large players simply will not participate. It's way too dangerous for them.
So by launching these 5-year bond futures, Hong Kong is handing institutional investors the exact tools they need to feel safe.
Right. They are telling the high rollers, the cashier's cage is fully stocked, the insurance policies are signed, and we are ready for your business.
That makes total sense. They are building the complete package, the physical vault, the legal bridge, and the cashier's cage.
Yes. All 3 pillars.
Let's bring this all together and look at the broader geopolitical menu here. Because what does this actually mean for the U.S. dollar?
That is the big question.
Especially for an everyday American investor just watching their portfolio. To ground this in our current reality, with Donald Trump currently in the White House, the U.S. has shown it is very willing to use the U.S. dollar as a geopolitical tool.
Right, through sanctions, tariffs, or restricting access to the banking system.
Exactly. We aren't taking any political sides here, just looking at the mechanics of foreign policy. The dollar is clearly used as a tool.
It is a fact of modern finance, yes.
So, looking at this highly sophisticated infrastructure Hong Kong is building, does this mean the U.S. dollar is in immediate danger of being replaced?
No. The short answer is firmly no, and we have to look at the macroeconomic data objectively here.
Okay, so it's not the death of the dollar.
Absolutely not. The U.S. Treasury market is still completely unmatched.
In terms of what? Size?
Size, depth, liquidity. You can move trillions of dollars in the U.S. Treasury market on a Tuesday afternoon without causing a single ripple in the pricing.
Wow.
It is by far the deepest financial swimming pool in the world.
So if it's not replacing the dollar, what is the actual goal of this Hong Kong ecosystem?
Well, according to recent analysis, this is about creating a multipolar financial world.
Multipolar, meaning not just one dominant player calling all the shots.
Exactly. Think of global finance less like a regular market and more like a computer operating system.
Okay, like Windows or Mac.
Right. For the last 80 years, the entire world has run on Windows dollar. Even if a country resents the software, they are forced to use it because all their trading partners use it.
The network effect is just absolute.
Exactly. So what Hong Kong and China are doing is basically attempting to launch macOS Yuan.
Giving people a second option.
Right, and to convince global institutions to even consider running a dual system setup, they have to prove beyond a shadow of a doubt that their hardware, the physical gold vaults, and their software, the bond futures, are completely bug-free.
That's a great way to think about it. They are offering an alternative menu option.
Exactly. If a sovereign wealth fund wants to reduce their reliance on the dollar system, Hong Kong now offers a complete package. Gold storage, Yuan liquidity, and Chinese bonds.
All wrapped up in a trusted legal system.
Yes.
Okay, so for the beginner investor listening to this, how should they actually navigate this? What is the actionable investment strategy here?
Well, you have to look past the flashy headlines and watch the actual mechanics.
Like what, specifically?
For an investor looking out, say, 1 to 3 months, the key metric isn't the government announcements, it is the actual trading volumes and vault usage.
Right, because anyone can announce a trial run for a clearinghouse.
Exactly. You need to see if central banks are actually depositing real physical gold into those new vaults.
You have to see if the Amazon fulfillment center is actually shipping boxes, not just sitting empty.
Spot on. Now, looking out 6 to 18 months, investors should really watch how much those new 5-year bond futures are actually being used.
The one's launching in August.
Yes. Are Western institutions actually using them? Because here's the real actionable takeaway. Financial infrastructure stocks might benefit the most from this.
Wait, break that down for me. If this whole new system is based around gold, how do companies benefit if the price of gold itself just stays totally flat?
Because financial infrastructure companies, like the stock exchanges, the clearinghouses, or the secure storage firms, they make their money on the sheer volume of transactions.
Oh, not the price of the asset itself.
Exactly. If Hong Kong routes unprecedented amounts of gold and bonds through this new ecosystem, those companies collect a fee on every single transaction.
Wow, so they're basically selling the pickaxes and the blue jeans during the gold rush.
That is exactly it. Even if the price of an ounce of gold stays flat for 2 years, purely an increase in transaction volume moving east could be a massive tailwind for those infrastructure stocks.
That makes perfect sense. It's all about owning the plumbing, not trying to predict the price of the water flowing through it.
Absolutely.
So to summarize the sheer scope of what we've covered today, based on the data, Hong Kong is not trying to become London overnight,
No, they aren't.
and they aren't trying to overthrow the US dollar by next week. Instead, they are methodically pouring the concrete for a parallel system.
Yes, piece by piece.
They are building massive physical vaults for trust, linking that to mainland demand through Delivery Connect, and building out complex bond plumbing so institutions feel safe enough to actually play in the casino.
It is a slow, deeply structural shift, a multipolar experiment happening in real time.
It is a fascinating evolution of the global market, and it leaves us with something really profound to think about. I want to leave you with a final question to ponder as you review your own portfolio.
It's a good one to consider.
Yeah. If gold is slowly transforming from just a traditional passive safe haven asset that you only buy when stocks look shaky into the actual structural foundation of a rival currency system, how might that fundamental shift change the way its price moves over the next decade?
It definitely might not behave the way the old textbooks say it should anymore.
Something to really keep an eye on. Don't forget to subscribe and hit that like button.